Now, I totally get it. As a business owner myself, you've got enough on your plate. You've got sales that need to come in the door. You've got to manage your team, and you have to get product out the door. That the monthly close process is probably not even in your top 10 list of things that you want to think about on a regular basis. I will explain to you what this monthly close process actually does so that you as a business owner know that you are making decisions based on accurate information. Especially as your business starts to grow, it is important that you have this monthly close process finely tuned. It's like driving a vehicle with outdated maps. If you're not really going fast, or it doesn't really matter how quickly you get there, then it doesn't matter as much. But the more finely tuned that engine, or the more volatile the conditions that you're driving in, the more important it's going to be to have accurate monthly close. So before we get into the monthly close, it's going to require us to define the terms cash versus accrual accounting, because the monthly close process is all about making sure that these are accurate. So think of cash accounting as running your business based off your bank balance. This is how much we have today, and today this many deposits came in and this many expenses went out the door. This is your basic level of transaction reporting. The problem with cash accounting is that it doesn't really take an eye towards the future. So accrual accounting is the solution for that. In September, we invoiced this many sales, but clients aren't paying promptly. They're going to pay in October, they might pay in November, they might pay even further out. Accrual accounting solves for that. On the payables side, we received an invoice from a vendor for today, but we're not going to pay that ourselves until 30, 45 days or even 6 months down the road. So this is what accrual accounting tries to solve for. If you run your business based off of cash, you're going to know, do I have enough cash to make payroll this coming week? But what you're not going to know is you're not going to know, are we saving up enough for unexpected expenses 3 months down the road? And you as a business owner are going to find a proper balance between how you like to run your business, but you're going to want both there as an option so that you could keep an eye on the future and also prioritize things in the present. So why is the monthly close such a big deal? And more importantly, why should you as a business owner care that it's being done efficiently and timely? Now, if you're like most business owners, this is the last thing on your mind, and so you're going to put off your accounting until the end of the year, until tax time, because you have a firm deadline there when everything has to be reported. We deal with plenty of business owners that are like this. The problem that they have is when I ask them a question about last year, their response is usually, I can't tell you what I had for lunch last Tuesday, and you're going to ask me about an expense that went out the door 15 months ago. Just like anything that piles up due to lack of attention, it's going to be easier on you if you break that up into small chunks and you're dealing with it in monthly intervals rather than letting it all accumulate until the end of the year. Think of that monthly close as a regular monthly checkup. We are keeping an eye on things now before they snowball and they get out of hand. So fundamental, critical to that monthly checkup at bare minimum is going to be a monthly bank reconciliation of all your accounts. This is going through your transactions and making sure that they're accurately reported, that they're not duplicated or missing, and that if you do write checks still, that your outstanding checks, you've kept an eye on them and you're voiding any checks or reissuing them as might be needed. During this process, you're also going to look at your accounts receivable and your accounts payable. One, again, you're going to make sure that payments are properly being credited to the right invoice. You're also going to look at those older accounts, anything that might be over 30 days and then even out over 90 days. Do you need to contact customers now to get payment? Do you need to make sure, call your vendors and apologize if you missed a payment? Do you want to make sure that your vendors are properly crediting your account with payments that have been made? What we're really looking for here in the monthly close is that each month the income and the expenses related to that month are properly represented, that we're not weighting all of those expenses at the final month of the year, that if we have an annual expense, that it is being allocated properly over those 12 months so that we know in a given month what our income needs to be at to cover our actual expenses, whether they are paid or just accrued this month, so that we as business owners can properly know what our revenue targets are. Now, I know up to this point, I've got some business owners who are with me, and a lot of my CPA friends are saying, yes, accuracy, monthly close, get it all dialed in and perfectly reported. And to those, I say your monthly close is probably taking too long. If you're the type of business owner that obsesses over every penny and you're dragging out that monthly close until everything can be accurately 100% represented, you're making decisions in the dark with information that is outdated. Your monthly close for most businesses should not take longer than 2 weeks. I'm actually going to share some tips at the end of this video on how you can get that down to even 2 or 3 days. Because if you're taking that long to close the month, and trust me, I have seen books that are still working 6 months down the road on closing that month, you're not getting the information that you need that's actually actionable. It's outdated and it's useless by this point. While the monthly close process is important, it's also important that we as CPAs, controllers, or the very attentive business owner don't lose the forest for the trees here. That accuracy is important, but you're not in the business of bookkeeping. There's no annual award for perfect books. Our function in the accounting department is to organize data so that it's actionable. I remember the first CFO that I ever worked with, and this is after growing up in public accounting, especially working for a partner who cared about detail down to the exact penny. And that CFO told me when I first started working on that company's books that 90% in 3 days is better than 100% in 3 weeks. And his point was, we need to get that information to the business owner so that he can make accurate decisions for this month, rather than waiting until next month to get details on the previous month. And if your close is taking 3 weeks or longer, that's actually what you're doing. You are making decisions for November in October based off of September's numbers. And that information is inaccurate, and you're making costly mistakes in your decision making. And I think most business owners realize this, and this is why they don't prioritize accounting. It's funny, as CPAs, we say, why don't business owners care about their numbers? But then we take them 8 to 9, 10 months sometimes even to get them the accurate numbers. And we're really reinforcing that stereotype here. You are making decisions based off of gut, based off of instinct, based off of experience, based off of being really good at sales. And so I'm just going to bring in revenue, let the chips fall where they may, and it's going to take a long time for our accounting department or for my CPA to figure out where the numbers actually ended up. If we don't get that monthly close process down to something that is timely, then the business owner is going to walk away and move on and make decisions based off of the back of the napkin calculations. So it's incumbent upon us as the financial professionals to make sure that this process is moving smoothly so that the numbers actually mean something when we get them to the business owner. So if we are now both on the same page, you as a business owner and me as a CPA or your controller in your accounting department, how do we both work together to make sure that that monthly close process gets down to a timely close to produce those numbers that matter? So the first thing that I'm going to say is it's going to take baby steps. If your current process is greater than a month, let's set it to 3 weeks and start there. Eventually we need to work our way down, and this is going to take a period of months. It's going to be a shock to the system. If you are catching up outdated books, you want to try and keep your books current while still closing those prior periods so that you're not just pushing that 5 to 6 month window down the road. It's going to require you as a business owner to have your controllers back. When the controller sets deadlines, you have to stick to them, and you have to ensure that the team sticks to them as well. And so we're going to work with baby steps, and we're going to gradually shave off time. Now, once you get your business closed to under a month, we want to shoot for 2 weeks. 2 weeks is standard. Public companies are able to close their books and have everything reported within even less than 2 weeks. So this is a standard that we want to shoot for. So how do we actually work to get a monthly close down to 2 or 3 days? So my recommendations are going to come down to 3 broad categories of ways to speed up this process. And those are going to be automation, simplification, and standardization. So first, automation. Anything that we can do to automate this process. So does your accounting system allow for bank imports of transactions so that those don't all have to be manually keyed in? If not, can we import CSV files? When we're adjusting AR or AP, are we able to export a CSV file, make our adjustments to that CSV file, and then re-import it into the process? That's going to speed up that process rather than manually adjusting each transaction one at a time. For any technicians that we might have out in the field, or just salespeople, or anybody in the company that's got to send documents back to accounting, could we give them an app on their phone so that when they're at the restaurant, they can snap a receipt and it goes directly back to their expense reporting, something like Expensify that they can use to reconcile their credit card. So there's going to be a lot of these little tools to automate that's going to speed up a lot of that manual entry. Now, a word of warning here, anytime that you automate something, do not just think that you can set it up and walk away from it. Especially when it's new, it's going to take some extra attention from you to make sure that the data that's coming in is good data. You don't just want to dump all that bad data in there because you're going to create a mess for you to clean up. But once you've paid attention to it and it is set up, you're going to just only want to check it so often to make sure that it's continuing to operate as needed. All right, my second recommendation is simplification, and I'm going to step on a lot of toes here, but I'm willing to bet that your chart of accounts is probably too big for your company. I am of the mind that our chart of accounts should be simple, that most of our accounts should be consolidated together. I'm talking specifically to those companies that are still operating off of the QuickBooks default chart of account that have separate accounts for postage and printing and reproduction, and then a generic office expense. You're really not going to get actionable data from breaking out those expenses that detailed, and so those really need to be consolidated into one. I have clients who've got dozens of auto loans. Those can be consolidated into one single notes payable line. The same way that we do with fixed assets. I remember early on, I had a photography client and he set up his own QuickBooks, and every single fixed asset line was its own separate asset account on the balance sheet. Some of these things might have been $35 purchases, but he was recording them all with separate line items in the chart of accounts. So The first step to a faster monthly close is to consolidate the chart of accounts and simplify the number of accounts that we actually have to tie out. My recommendation for this, if you are simplifying the accounts, the main ones you want to split out are going to be variable accounts that go up as revenue goes up, that go down as revenue goes down, and then fixed expense accounts, ones that are just consistent. Those can be separated from the variable ones, and that'll allow for better budgeting. If you have to make a decision on whether something needs to be grouped together, if they're both fixed expenses and they're within a broad category of each other, they can be grouped together. The second recommendation for simplicity is going to be setting a materiality threshold, or only measuring items that you need to measure only for as long as you need to measure them. So a lot of the stuff that we track in our accounting system, because it was added to the accounting system at one point, means that that line item is going to be tracked month in and month out for years. Something like job profitability report, you could set a threshold for your company. All jobs under 0.5% of annual revenue are just going to be defaulted. We don't need to track individual profitability on those jobs. You can also set a materiality level for your monthly close. Any expenses that come in after the 31st, if they're under a set amount, $5,000, $20,000, whatever material means for your company, those get posted in the current period rather than reopening that prior period and delaying that close even further. And the last recommendation for speeding up that monthly close is going to be standardization. So a lot of top companies will set a soft close prior to the monthly close. And so they might pick like the 25th of the month. And they say everything after the 25th is going to be dealt with as stragglers, but we're going to do a hard cutoff on the 25th of the month. So you're really only dealing with 5 or 6 days there. You're getting your bank reconciliation. You're dealing with those stragglers, closing the books, and then moving forward. And you've got it done by the 2nd or 3rd of the month. There is a popular movement in a lot of advanced companies, technology companies, what are called rolling closes. And so they actually don't have a monthly close. They're just rolling continually the close. Could be every week they do a close or every day they do a close. You'll see, especially with large companies, because of the volume of transactions that they actually have to batch all of their transactions every single day. And so your day's transactions or your deposits and your withdrawals, that day they hit the bank, that gets batched into a daily bank reconciliation. And then when you get to the end of your month, you do a monthly bank reconciliation, grouping 30 or 31 of those together, and your bank reconciliation is done. So you might experiment with that with your company as a way to speed up the monthly close process. Set a weekly close, cut it off at the 31st of the month, and then start the next month's week. And the last piece of standardization, this part really is essential. You need a checklist for your monthly close. And not only do you need a checklist that you as the controller are in charge of, but you need to know every item on that checklist has a due date and it has a person held accountable for meeting that due date. So if it's AR, your salespeople have to have this due date to have everything to you before the end of the month. Your partners who have credit cards, they have this date in order to get all of their expenses entered, reconciled on the credit card and get it to you. HR department has this date for a cutoff for getting you the final payroll accruals for the month. Standardization, simplification, and automation are really going to be the keys for you to speed up the monthly close process to get it down to 2 or 3 days. So now that we're all on the same page about the monthly close and the importance of its timing, what numbers should you as a business owner actually be looking at from your financials so that you can make better decisions? I'm going to cover that in this video next, but I want to thank you for watching and I will see you over there.